The One Big Beautiful Bill Act was signed into law last year, and you may be wondering how it affects your tax filing for 2025. Are you going to be able to take advantage of the higher SALT cap deduction? Or maybe you can take advantage of the new car loan interest deduction. This is SWBC's Uncharted Wealth Podcast, episode 24. We're back, baby! Hello, everyone, and welcome back to another episode of Uncharted Wealth. I am your host, Mike Walters. I'm a wealth advisor here at SWBC. And today, we're going to talk a little bit about tax filing now that we are pretty much through the 2025 tax filing season. So today, I'm going to be talking a little bit about the changes that happened when the OBBBA, which is the One Big Beautiful Bill Act, passed last year. And some of those changes that you can expect to see on your taxes for 2025. I'll discuss the higher SALT cap, the higher standard deductions, the new enhanced senior deduction, and a few other things you should be aware of as you file. Now, the One Big Beautiful Bill Act was signed last year on July 4th, 2025, and it made a lot of the Tax Cuts and Jobs Act era rules permanent, okay? And now I'm not going to refer to the Tax Cuts and Jobs Act. I'm not going to say that whole thing throughout the episode. So when I say TCJA, that's what it is, the Tax Cuts and Jobs Act of 2017. And so what it did was it made a lot of the individual rules permanent, okay? So for example, the SALT cap. If you don't know what that means, it means state and local taxes, right? SALT cap. Now, originally, it was capped at $10,000, which, you know, if you're looking at your property taxes, which is mostly what people will use that for, in a high property tax state, that could be pretty good. But because the standard deductions were so high, and that cap was fairly low, it made more sense to do a standard deduction. But now with this SALT cap increased for the 2025 tax filing season, the state and local tax deduction cap is now $40,000. Okay, it will increase by 1% through 2029. However, there is a phase out above $500,000 of modified adjusted gross income, and there is a $10,000 deduction floor for all income levels, right? So it means you can't lose your $10,000 minimum no matter what income level you have. Now, for those of us Texans that have some sizable property taxes that haven't engaged with our SWBC ad valorem division to maybe bring those down, this could be an opportunity to itemize again now that you get to deduct more of those property taxes. Now, the next thing is more actionable for most folks is that standard deduction that I was talking about. The larger TCJA era amounts is now permanent, right? Because they were supposed to sunset in 2026, but with the passing of the OBBBA, those are now permanent. Now, the standard deduction is now set at $31,500 for married filing joint and $15,750 for our single filers. This will be indexed with inflation every year afterwards, as it normally does. So your decision of should I itemize should now be should I optimize with these new deductions. So here's some more to think about. The enhanced senior deduction is now for those age 65 and older. Okay, it is a temporary additional deduction up to $6,000 per qualifying taxpayer. So for those that are married, it's $6,000 each. Phase-outs start at $150,000 for the joint filers and $75,000 for single filers. Now, this stacks on top of the already standard deduction, and it will keep a lot of retirees in the standard deduction mode unless they are optimizing elsewhere. Another temporary deduction is the no tax on car loan interest. Now, I'm not telling you to go out there and buy a brand new vehicle just to get a little bit of savings on the interest, but this is only available until tax year 2028. It allows you to deduct the interest paid on new car loans purchased in 2025 and beyond, but the vehicle must be qualified. And what does that mean? It means that the final assembly of that vehicle must have taken place in the United States. So for retirees who may be looking to purchase a new vehicle, but they decide to finance instead of paying cash, maybe to preserve some of that liquidity, this can help offset those interest costs. Now, a quick mention for my phased retirees out there, okay? So those that are already in retirement, but kind of like a phased version of it, the no tax on overtime and no tax on tips. Like generally that does not apply to most of my retiree clients, but for those that may still be working some kind of part-time or phasing out their retirement, this might apply to you as well. So just be mindful of the income phase-outs when it comes to the no tax on tips and no tax on overtime. For our folks that are charitably inclined, there are some big changes on the charitable giving side of things as well, mainly with our people that are taking the standard deduction. There's a new above the line deduction where you can still get some credit. Now this is something that they did away with for a little while and now it's back. For our single filers, you can take a charitable deduction of up to $1,000, and for our joint filers, you can take a deduction of up to $2,000. So it's a simple way to get some kind of credit for your giving that you're doing throughout the year without itemizing to optimize. For those that do itemize, there is a new 0.5% of AGI floor. Okay, that means that 0.5% of your deductions are not going to count. You have to pass that 0.5% floor first in order for you to get any type of benefit on your Schedule A. Now, it will reduce the value of these smaller gifts that you may do, and it'll nudge planning towards using QCDs or donor advised funds. But it is something to be mindful of, that 0.5% of your AGI in deductions is not going to count, only what's above that amount. Speaking of QCDs, these are qualified charitable distributions. I know we've talked about them in a past episode, but this is if you are 70 and a half or older, you can take a distribution from your IRA, your pre-tax account, and directly transfer that to a qualifying charitable institution. Okay, it keeps the amount excluded from your AGI, and you can still satisfy your RMD for the year. The cap for 2025 is $108,000. So you can literally take $108,000 out of your pre-tax IRA, give it directly to a charity. You do not have to count that for your income, and you still get the charitable deduction. This technique will often be more beneficial than itemizing, especially those that are near those Medicare IRMA thresholds that I've talked about a million times before. Now, the last point I want to make is directed towards our very high earners, okay, in the 37% marginal tax bracket. The OBBBA caps the value of your itemized deductions at the 35% rate, not the 37% rate that you would expect. So for example, if a $10,000 deduction is not going to save you $3,700, it's only going to save you $3,500. Now that's not a huge difference, but if you have a lot of deductions, that could tally up over time, okay? This is going to matter for high income years where you have a business sale, maybe you're doing a large Roth conversion or big capital gains. You want to make sure you model the impact of maybe bunching deductions and considering QCDs, spreading gifts over multiple years in order to get the full benefit. So that way you're not losing that 37 to 35% cap. Now, before I jump into the Uncharted section, I want to remind everybody that if you have not liked, commented, or subscribed to the channel, now is your time to do so. Always remember, if there is a specific topic that you would like me to discuss, make sure you leave it in the comments below, and we'll make sure to get it added to a future episode. Now, for some action items between taking the standard deduction and the itemized route, okay, here's a quick decision tree for deciding what you should do. Obviously, this is for those self-preparers, but if you want to wow your tax preparer, then you can also have a conversation about this. But you should consider itemizing if your SALT plus mortgage interest plus medical expenses. Remember, there is a 7.5% AGI floor for that. Your charitable contributions will exceed the standard deduction. Now, that's a little bit obvious, but just a reminder with the the state and local tax, the SALT deduction now at $40,000, homeowners that have these higher property taxes are now back in the conversation. The second reason you should consider itemizing is if you are bunching your deductions. So if you're bunching your property taxes into 1 year to cover 2 years, if you have elective medical expenses that can push you into a higher expense year, or if you're utilizing a donor-advised fund to give gifts in 1 year to clear that gap, that should be a good indication that itemizing might be your best route. On the flip side, you should consider taking the standard deduction if you either don't have a mortgage or you locked in those really, really low rates over the last 4 or 5 years. No mortgage, low property taxes, and especially with the enhanced senior deduction on top of the standard deduction, it is quite a hurdle to pass. Also, if you're managing those IRMA thresholds, QCDs plus the standard deduction will usually beat your Schedule A, your itemized deductions. That might push your modified adjusted gross income over those IRMA thresholds and have you paying more on your Medicare premiums. And then the last reason why taking the standard deduction might make sense is if you are in that 37% marginal tax bracket, because that cap will limit you to 35%, so your Schedule A benefits may not be getting the full amount right now. Which brings us to our Uncharted section. For today's Uncharted section, I'm actually going to go through a client situation that we recently uncovered. Now, I have a client couple who donates monthly to their favorite charity, and in a normal year, they take the standard deduction because their property taxes are kind of low. They don't have a mortgage. Their medical expenses are little to none. And their annual giving doesn't really bring them anywhere close to that standard deduction, and now with the enhanced senior deduction. It doesn't clear that, so there is really no benefit, or at least no tax benefit from giving to his charity. Now here's the move, okay? We bunch his charitable gifts into every other year, right? So here's how it works. In year 1, he's going to contribute 24 months worth of his giving all at once. And by front loading that into a single lump sum payment, okay, combine that with his property taxes, maybe we bunch those as well, whereas you prepay next year's property taxes and pay the current year's taxes all in 1 year. That will push his Schedule A with his itemized deductions well over to the standard deduction, okay? And then in year 2, he's just going to take the standard deduction plus the enhanced senior deduction, which is what he was already used to doing. Now this works because the higher standard deduction means most retirees are not itemizing anymore. But bunching these types of deductions in 1 year, it can concentrate your deductions into 1 year so that you can get over that standard deduction hurdle by a healthy amount, and then the next year you can just snap right back into the standard deduction. Now also with the SALT cap temporarily higher, homeowners that are in these high property states like Texas, they can easily stack enough of these property taxes along with maybe some charitable contributions to get you over that standard deduction. Now, in closing, I'm going to remind everybody you need to consult with your tax preparer, your CPA, your enrolled agent to make sure that any of these new updates from the OBBBA affects your situation. And if you have any questions on them, you need to consult with them. Now, if we can help here at SWBC, we can ensure that your financial plan and your investment strategy align with your tax plan. We can even coordinate with your tax preparer if needed. I do it all the time, just to make sure that everything is flowing through to the tax return as it should. As a reminder, everything that I talked about in today's episode is not to be taken as financial, legal, or tax advice, and any opinions shared are mine and mine alone, not of SWBC, the company, or its shareholders. Thank you for joining me on this edition of SWBC's Uncharted Wealth podcast. Make sure to like, comment, and subscribe, and we'll see you next time. they all just kind of like, Girl.
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.